You're 55. You've got maybe $80,000 saved, and you just freed up $500 a month to start putting away seriously. The question isn't whether to save, it's where to put it first. Because putting it in the wrong account, in the wrong order, isn't just a small inefficiency. Over a decade, it can be the difference between retiring on your terms or not retiring at all. Here's a number that stopped me cold when I first saw it. According to Vanguard's How America Saves 2026 report, the median 401k balance for workers aged 55 to 64 is $107,269. Not the average, the median. Half of near retirees have less than that. So, if you're sitting there feeling like you're behind and alone in that, you're not. You're actually right in the middle of this thing. What most people do when they finally decide to get serious is just throw money at whatever account they have, usually a 401k, and assume more is better. My take is that's wrong. The sequence matters enormously, and nobody talks about the sequence. That's exactly what we're going to work through today. Let me start where almost every conversation about catch-up contributions should start, and almost never does, your employer match. Before anything else, before the HSA, before the IRA, before any of the catch-up math, the right move is to contribute to your 401k up to the full employer match. Every dollar of match is a guaranteed, immediate 50% to 100% return on your money before the market does anything at all. There is no investment product on earth that competes with that. Vanguard's data shows the average employer match in their plans runs about 4.6% of pay. The median is closer to 4%. So if you earn $75,000 a year, capturing the full match might cost you around $3,000 to $3,450 of your own contributions. That's step one. Don't stop there, but absolutely start there. Now, one thing worth knowing, the 2026 total employee deferral limit in a 401k is $24,500. That's up from $23,500 in 2025 per IRS Notice 2025-67. If you're 50 or older, you can add an $8,000 catch-up on top of that, bringing your annual personal contribution ceiling to $32,500. And if you happen to be between ages 60 and 63, specifically 60, 61, 62, or 63, Secure 2.0 lets you use a super catch-up of $11,250 instead of $8,000 for a total of $35,750. That window slams shut the day you turn 64. Worth knowing. But here's the real-world problem with those numbers. A worker earning $80,000 would need to defer over 40% of gross income to max out the full $32,500. Vanguard's own data shows fewer than 1% of participants earning under $30,000 make any catch-up contribution at all, and only 52% of those earning $150,000 or more do. The limits are almost beside the point for the person I'm talking to. What matters is making the right call with the dollars you actually have. So once you've captured the full employer match, here's where my view diverges from what you'll hear from most planners. The next dollar should go into an HSA if you're enrolled in a qualifying high-deductible health plan. I know that might sound counterintuitive. The 401k has the bigger contribution limit, so why skip ahead to the HSA? Because the HSA is the only account in the entire U.S. tax code that is triple tax advantaged. Your contributions go in pre-tax, the money grows tax-free, and qualified medical withdrawals come out tax-free, not tax-deferred, tax-free, deferred. A traditional 401k is only pre-tax on the way in. The HSA beats it on every axis for eligible savers. There's also something that almost nobody mentions when they talk about the HSA. When you contribute through payroll, you avoid FICA taxes, Social Security and Medicare, on those dollars. That's an extra 7.65% you save right off the top. A Roth IRA can't do that. A 401k can't do that either, at least not on the FICA side. For 2026, the IRS set the HSA contribution limit at $4,400 for self-only coverage under an HDHP and $8,750 for family coverage, up from $4,300 and $8,550 respectively per Revenue Procedure 2025-19. If you're 55 or older, you can add a $1,000 catch-up on top of whichever applies to you. That catch-up is not indexed for inflation. It's been fixed at $1,000 for years. So you get $5,400 self-only or $9,750 family if you're 55 or over. To qualify, your health plan has to meet the IRS definition of a high-deductible plan. For 2026, that means a minimum deductible of at least $1,700 for self-only or $3,400 for family, and an out-of-pocket cap no higher than $8,500 self-only or $17,000 family. Whether you're enrolled in one of those plans is entirely your specific situation. I can't answer that for you. But if you are, the HSA slot is almost always worth filling before you go back to the 401k. One more thing about the HSA that I want you to hold on to. After age 65, if you pull money out for non-medical expenses, it's taxed exactly like a traditional IRA withdrawal. So, worst case, it works like a 401k. Best case, which is if you use it for healthcare costs, it's completely tax-free. That asymmetry is why it belongs in the sequence before more 401k contributions, not after. After the employer match and the HSA, here's where I'd put the next available dollar. A Roth IRA, if your income allows it, and if not a Roth, a traditional IRA. For 2026, the IRA contribution limit is $7,500. That's up from $7,000 last year. And here's something worth noting because it's genuinely new. The age 50-plus catch-up on an IRA just increased from $1,000 to $1,100. First time that number has moved since it was originally set, which was honestly a long time coming. That brings the total IRA contribution ceiling for someone 50 or older to $8,600 for 2026. I'll actually have a full breakdown of that change next week. It's more nuanced than it looks. Now, income limits matter here. The Roth IRA phase-out for 2026 starts at $153,000 for single filers and heads of household and phases out completely at $168,000. For married filing jointly, it's $242,000 to $252,000. If you're above those ceilings, direct Roth contributions aren't available to you. There's a strategy called the backdoor Roth that higher income savers use as a workaround. That's a separate conversation. But the income floor is real. If a Roth IRA isn't available to you and you're considering a deductible traditional IRA instead, check whether you're covered by a workplace plan, because that changes the deduction math significantly. For 2026, if you have a 401k at work and you're single, the deduction starts phasing out at $81,000 of modified AGI. For married filing jointly, it's $129,000. Above those thresholds, your traditional IRA contribution is still allowed. You just may not get the upfront deduction. The reason I put the Roth IRA ahead of additional 401k contributions in the sequence isn't just the tax-free growth, it's control. Your IRA sits outside your employer's plan. You pick the investment options. You're not locked into whatever lineup your HR department negotiated. For the people I work with, folks 50 and over who are making serious moves on their retirement, that flexibility matters. The 401k is excellent for matching dollars. Beyond that, the IRA gives you more room to maneuver. Once the match is captured, the HSA is funded, and the IRA is maxed, then, and only then, do I think it makes sense to go back and push additional dollars into the 401k toward the full $32,500 limit. For most people with one income stream, this is where the math gets hard. But if you have the cash flow, or if you've paid off debt and freed up room in your budget, this is legitimate territory. There's a new wrinkle for 2026 that I want you to be aware of, especially if you're a higher earner. Under Secure 2.0, workers who earned more than $150,000 in prior year FICA wages are now required to designate all 401k catch-up contributions as Roth. That threshold rose from $145,000 to $150,000 for 2026. If you're above that line, and I mean your FICA wages from the prior year, not just your gross income, your catch-up contributions are Roth by law, not by choice. If your employer plan doesn't offer a Roth option, you lose catch-up eligibility entirely. That's worth verifying with your HR department before you assume anything. I want to be honest about the implications there. If you've been deferring catch-up contributions pre-tax as part of a tax strategy, that option may just be gone for you now. Your filing status, your current marginal bracket, and what you expect your bracket to look like in retirement all factor into whether the Roth mandate hurts or actually helps you. Your specific tax picture is something a fiduciary advisor can model in an hour, but the rule itself is now settled. One more thing in the 401k section that I want to mention for completeness. There's also an overall combined limit, what the IRS calls the 401c annual additions cap, which covers the total of your contributions plus your employer's contributions. For 2026, that ceiling is $72,000. Realistically, almost no late starter is bumping against a $72,000 combined limit. But if you have after-tax 401k contributions available in your plan, it's worth knowing that number exists. Let me put the full sequence together plainly, because I find it's easy to lose the logic when there are numbers flying around. First, contribute to your 401k up to the full employer match. Full stop, no exceptions. Second, if you're enrolled in a qualifying HDHP, max your HSA, $5,400. If you're 55 or older with self-only coverage, $9,750 for family in 2026. Third, fund a Roth IRA if your income allows. $8,600 total for age 50 plus in 2026. Roth if you're under the income ceiling, traditional if not. Fourth, after all of that, push additional dollars back into the 401k toward the full catch-up limit. The reason that order works is it captures guaranteed returns first, then triple tax advantage, then control and flexibility, then raw contribution volume. Most planners I've seen reverse steps 2 and 3 or skip the HSA entirely. Honestly, I think most advisors get the HSA placement wrong. They treat it like a healthcare account, not a retirement account, and they sequence it last rather than second. I also want to say clearly, this framework assumes you have cash flow to fund multiple buckets. If your budget only stretches to the match and maybe half the IRA, that's not failure. That's reality for most people in the Vanguard data. The $107,269 median isn't there because people made bad sequence decisions. It's there because life is expensive and wages didn't keep up. The right sequence still matters, even at smaller dollar amounts, because every dollar has a best home. There's also a credit worth knowing if your income is in the right range, the Savers Credit. For 2026, the IRS set the income limits at $40,250 for single filers, $60,375 for heads of household, and $80,500 for married filing jointly. If you're under those thresholds and contributing to a retirement account, you may qualify for a non-refundable credit worth up to 50% of the first $2,000 you contribute. Not a deduction, a direct reduction in your tax bill. Worth checking. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this framework gave you something concrete to work with, a subscription helps this channel keep going. And it makes sure you see what's coming next week, because I'm going to walk through that IRA catch-up increase specifically. The $1,100 figure sounds small, but the fact that the IRA catch-up finally moved after being stuck for 2 decades has some real downstream implications. And there's a nuance in how Secure 2.0 indexes it going forward that I don't think most people have caught yet. If there's a specific retirement question on your mind, Social Security timing, how to handle a pension alongside a 401k, anything, drop it in the comments. I read them and I build upcoming videos around what you're actually asking. This video may contain affiliate links. I only recommend tools I use personally.